Hi there, I'm Dave Snider, and this is Cory Whitesell, and we represent Chateau Capital. We're going to share some ideas today that we think might be quite helpful to you in the process. And if you have any questions at the end, we're going to have a little Q&A at the end. So we welcome your input and questions there, and some of you are also welcome to send those in by email. At Chateau Capital, we invest carefully so that you can, there you go, so that you can invest passively. You can earn more and worry less passively and repeatedly, purposely, and tax efficiently. Somewhere here in the next few weeks, we'll be celebrating our 250th anniversary as a country. I want you to recognize that if you were to look at a $100 bill, you might find somebody's face on it that wasn't a president, and there's a reason he might be there. Benjamin Franklin, when he sat down at age 83 to write his will, it was in 1789, he wrote a document that impressed the world with who he was and what he was about. And it affects us here. It's a concept that, let's just say this, the document is in the archives of the Commonwealth of Massachusetts, and it's pretty simple. It's not long, it's not complicated. But he said that here, I'm giving £1,000 to the city of Boston, £1,000 to the city of Philadelphia. But then the stipulations were this had to be used for positive purposes, charitable causes for 100 years. You cannot touch or deplete the principal for 100 years. Then in 100 years, you can deplete only a small portion of it for a charitable cause, but the rest of it had to continue working for charitable causes for another 100 years. At the end of the 200 years, you could deplete more of it and or all of it as long as it's for a charitable positive purpose and a cause. The point I would make about that is today there are people in Boston and Philadelphia and many of us Americans who are eating the fruit of his orchard, shall we say. We Ben Franklin was planting orchards that he knew he would never sit under the trees. He knew that you and I would sit under the trees. He knew that our children would sit under the trees, and free Americans, he would hope, 200 to 250 years later, would be sitting underneath his trees. And so he had a model at age 84. He died actually April 17th in 1790, but he'd retired at age 42 because he'd built assets that paid him. So in his final hours, he wasn't worrying about what to do with his pile. He was planting trees that he knew other Americans would sit under for centuries. An 84-year-old man had a view and a vision of centuries like that. And that's something that we celebrate. And I think that's one of the reasons, or as Paul Harvey would say, now you know the rest of the story, why he might be on our currency as he was thinking about us long term. That's part of what you get the privilege of doing if you invest into multifamily. You're investing in housing, things that'll be here for a long time, protects and provides for people like that. I want to give a legal disclaimer right up front that says we are not acting as your attorneys or your CPAs. Cory acted as a CPA for many years and senior tax associate for Deloitte, as well as senior tax manager for Wachovia, as well as senior tax manager for Wells Fargo. We are not acting in any official capacity. We encourage you to get your own advisors, your own tax attorneys. We know many of those and would be happy to put you in touch with them. But ideally, legal professionals and financial professionals who own real estate and understand the benefits from firsthand use. But nonetheless, that's up to you. I wanted to let you know that in the run up after COVID, when COVID did their lockdown, it was a different world that particular year. Most of you might remember 2020, what it was like. But when they led up towards the end of 2020 and at 21 and 22, there was what's called a run up in values of single family and multifamily properties that was on the insane side. I remember as being one who was making offers on properties. The very best I could do was a full price offer if they would accept the terms that made it cash flow favorably to me. And of course, I didn't get very many offers accepted during that period of time. A lot of other people were paying dramatically over market price, assuming that like in '07, 8, 9, 10, the market would just continue to grow like nuts. So if things went up 20, 25%, let's just pay it. I'm sure it'll go up more than that. Well, that didn't play out so well. At those particular months and years, what was occurring on the rate side was the Fed funds rate was down near zero and historically had been dramatically lowered for so long. And banks were still offering variable debt. So instead of paying something in the high twos or the low threes if you wanted to cut a half point off that and get something like a 2.6 variable debt. There were people that thought that was a good idea, even though I didn't think it was a good idea. Here's the point I would make. It wasn't a good idea. And so about a half of $1 trillion worth of commercial loans are coming due here this year and 1.25 trillion next year of these assets, and we're positioning to take advantage of that. One of the things that I learned way back as a young man in my undergraduate years at Chapel Hill was I was what's called a college unit director. I recruited and managed 20 life insurance agents, and they would fly me, the company and the agency would fly me up to Milwaukee a couple times a year. And the investment director for Northwestern Mutual Life was given a presentation on why he thought wasn't what he thought, why he was proving that they had the strongest earnings of any insurer out there and the lowest expenses and the healthiest insured, and therefore they could pay these wonderful dividends to policyholders. There were no stockholders. And as a young man at age 21, I was a little short sighted. I didn't remember the stock market pain of 73 and 74 or 80 and 81. I just raised my hand and asked, can I ask a question? He said, sure, Dave. And I said, well, I bet you guys are crushing it in the stock market and in equities, aren't you? And he smiled one of those smiles that said, son, you have a lot to learn. And he said, actually, David, we don't invest that much in the stock market. He said, very little. We can't predict another downturn, another, say, 1929 or 73, 74, 80, 81. Said, we don't really invest and save up paper assets and spend down. We produce assets. We buy assets that produce, that pay us. It's a different way of thinking. And I said, wow. He said, I bet you have a lot of stockbroker friends, don't you? I do. He said, well, good for you. Uh, I said, well, what do you invest in? He said, we invest in a lot of commercial real estate, a lot of private equity, and a lot of multifamily apartments, assets tied to human life. They've been around for centuries. They're not going to be technologically outdated in 10, 20, 30 years. They're not going to be replaced by computer technology. We invest in assets that, for example, rents grow over time and properties values grow through good management. We invest in things related to people and human life. Dave, in case you didn't know, about 25% of the original S&P 500, those stocks are gone. They're either merged or closed or bankrupt or something. And only about currently, this was in the 80s, about 50% of the original stocks of the S&P 500 still hold their original spot. Let me ask you this. What if we thought we were really smart and we'd invested in the other half? Would you tell me that the S&P 500, you just can't go wrong with that because of that diverse exposure to all of the wonderful technological changes we're going through decade after decade? David, banks fail. We've seen banks fail. We've seen companies fail. We've seen investment firms fail. So we can't do that to our policyholders. We have to think like a steward for decades and for centuries. And I looked into it. He said, well, do you live in an apartment, by the way? I said, well, I do. He said, well, have rents gone down since 1945? I didn't have an answer, but as I suspected, the answer was no. Do you know how low the rents were in 1945? Look it up. Do yourself a favor and see where they are today. There's been a steady increase. So in 2024, life insurance companies held, about over three-quarters of a trillion in these investments. And that was before the July 2025 bill that gave us a lot more tax advantages. If you were to look into it and research it, private equity and hedge funds own about 25% of all of the major market multifamily apartments in Charlotte, Austin, Atlanta, Denver, major markets, and 10% ownership overall. Pension funds hold a lot of this. And he explained to me at Northwestern Mutual that a lot of the university endowments and that sort of thing, they invest this way. And to this day, if you look on Northwestern Mutual under real estate, they say we're hiring interns. And if you know anything about real estate, we'd like to hire you to come help acquire real estate for us. And they still invest heavily in commercial real estate, both on the debt side and the equity side. So I'm just giving you a snapshot of what that might look like. Pension funds, teachers' retirement funds, the market share continues to grow. I want you to imagine for a moment if your financial life was a bathtub and you decided to save in it and you decided to save paper assets such as just stock certificates, not necessarily dividend paying stocks, but stocks that would be growth stocks. And for 10, 20, 30, 40 years, everything flowed into the bathtub. You're filling it up, and then at some point you retire. And when you do, the arrows flip and it begins to drain. And what comes out? Well, if you have income producing stock, income. But if you don't, then you have what we call depleting assets. And the majority of the retirement programs out there today encourage you to do just that. Spend down what took a lifetime to build up. Literally deplete to survive, deplete to live. And what comes out of there, and I lived with this with my in-laws and my parents on a daily, weekly, monthly basis, annual basis, your living expenses, health care, that grandchild's tuition, that crisis that didn't check your calendar before it arrived, that health care expense that wasn't covered, that got my father-in-law moved back into his house when he needed to stay in a rehab facility, and on and on. And inflation causes anxiety. What we're here to tell you is that there's a better way. And it is in private equity and it is through multifamily, something that pays you. Yes, I have dividend stocks that pay me anywhere from 2 to 4%, and I'm glad I do. But in private equity and multifamily, you're often looking at 6 to 8% return on your money plus tremendous growth. And I get the question from time to time, well, who else shares your opinion about that? If you think private equity, well, my son's going to work for one of the largest private equity firms in New York City. They're worth just shy of $1 trillion. They started in 1987. They share that opinion. The teachers' retirement funds share that opinion. Insurance companies share that opinion. But just here's some operators. I want you to see that Ken McElroy is one of the largest, not only buyers, operators, and project property managers of multifamily. And in addition to that, they do a lot of ground up development of it. He has deployed 500 million, half of $1 billion in 2025. He's planning to deploy again an additional that much or more. So he's going from 3 or 4 billion up to 10 billion here in the next 2 years because of the crisis wave coming, and he's buying at pennies on the dollar. So this is him on a podcast, and you can look him up. Ken McElroy shows that way down here during COVID, the rates had been at historic rate levels, but unhistorically, first time ever in the history of America, our federal chairman of the Federal Reserve Board raised the rates at historic high rates for 11 times in a row. So people that bought in variable debt were stuck paying higher and higher rates. And about here, midway up, they became upside down where they're not making cash flow anymore. So there's that problem. There's also others that, for example, Tony Robbins is promoting his book called The Holy Grail of Investing. Well, he's been interviewed on a lot of major media sites such as CNBC. And in CNBC, they were explaining how, well, tell us why you think private equity is such a good idea. I want you to just listen to a quick clip from Tony Robbins for about a minute.
And as you well know, for decades, private institutions, big institutions, pension funds, ultra wealthy people have had access, but the general public has not had access, and most of them don't even understand the impact. For example, in the S&P 500 for the last 35 years, we know we've compounded at 9.2%. It's pretty darn good. You're doubling your money about every 8 years. But you've got 14.2%, not with these guys, with average private equity. So imagine getting 50% more per year compounded for decades. So as an example, if you had $1 million and you put it aside in the S&P 35 years ago, forgot about it, it's worth 26 million. Take the same million, same 35 years, put in private equity, average private equity, it's $139 million. So the ability to get much higher returns with less risk, which is what Ray Dalio's part of this book is about, is understanding the math of how to do that. And there's some new rules that make it accessible for people that are general investors.
It's come down, but let's be clear. And you make this point in the book, by the way, which is the private markets are now where the real money is going. Not to disrespect any of our audience and listeners out there that is going in the stock market. I'd take the 26 million on a million any day and twice on Sunday, so Tony.
Well, the point I would make is if you compound at your 9.2% interest rate and it just shows you over time, you do pretty good. You do pretty well. And we admire those folks who do that. And I have close relatives and dear friends who are investment professionals and advisors, and they do advise you earn stronger and higher returns if you get paper assets or growth stocks as opposed to dividend stocks. They might occasionally say if you want some dividend stocks or dividend funds, they have them. But if you invest in private equity at even average 14.2%, then over time, your monies grow more strongly. So the growth lines look about like that over time. You have to give it time. I'll give you an example. I bought a $300,000 golf course house back in early 2005. I moved to Asheville in 2004, was looking for a little flat place to play for my little 3-year-old about to turn 4. We found a little flat place with some yard on a golf course, put 300,000 to that house, and we still live in it. 21 or 2 years later, we still live in that same golf course house. And my son happens to be home from New York City. He's a PhD student at Columbia, and he's home for a week. But nonetheless, had I taken the same 300,000, I did take the same 300,000 and put it into real estate in other forms. But had I put it strictly into multifamily at an average rate of 14.2%, I want to show you what would have happened. 2005, when I purchased the home, if I'd put that into multifamily, then by 2010, that 300,000 would have doubled to 600,000. Then to 2015, that 600 would have doubled to 1.2 million. 2015 to 20, it would have grown to 2.4 million, doubling again. By 2025, using my fourth 1031 exchange, it'd be worth 4.8 million. It'd be producing 12,000 a month in cash flow. Oftentimes, a lot of that is considered tax-free cash flow because of the tax benefits with it. Now, I'm not sorry I invested real estate in other ways, but I'm just showing you this is what Tony Robbins is saying, the superiority of investing in just simply the S&P 500, which has companies that Blockbuster and Enron, they go under sometimes. So my house has probably tripled in value or better, but it just doesn't compare to multifamily. And here's one of the reasons we're excited about buying right now. There's only been 2 times in the history of the last 45 years where pricing for multifamily apartments have been on a downward trek. The first was during the '08 to 10 crisis, where people had used variable debt and they were in trouble when the rates went up skyrocketing, and they just walked away from them. And you could buy for pennies on the dollars from banks if you could negotiate with them. We're doing the same thing again. It started in 2022 or 3, and the bulk of it is coming in 2026 and 2027. It really started in 2025. That's why Ken McElroy invested a $500 million, and in another where he sat out, just like many of us who wouldn't buy if it didn't underwrite. And this is what we're seeing, the opportunities here. Caleb Troop is a senior managing director at Berkadia locally, and he says a telling stat is 52%, over half of our broker owner values were evaluating and giving you valuations on multifamily or on what's called distressed assets. And that means that today's value is less than what the current owner paid for it, or less than what it would cost to construct it, or the maturity is less than a year and they've got to get rid of it, or they're operating it below its occupancy of 90%. Well, there's a crisis that we're taking advantage of. This is just a larger picture of that. And why now? Why multifamily and Chateau Capital? One of the reasons is the tax efficiency of it. Each time you exchange, if you want to sell something, exchange into another. If you do that in the stock market, somebody will cry foul and say, I'm sorry, you can't do that unless you're putting it underneath a self-directed IRA or a self-directed Roth IRA or a Roth 401k or and so on, tax efficient structures. Generally you have the tax drag that you just do not have at the end of a 2-year, 3-year, 5-year, 20-year hold. And whenever you want to sell these properties, as long as you exchange it using one of the preferred and approved exchanged methods that our tax code allows, then you can defer that tax. And if you pass away and let's say your heirs inherit your properties, they get it on what's called a stepped up basis. And so the tax liability has just vaporized. So there's tax benefits to try to help you and encourage you to provide housing for people. CBRE is a major lender in this space, and they've long said that investing in apartments is wise for those who want to avoid high risk investments, but it outperforms stocks and bonds because there's monthly and quarterly cash flow. And this is just a picture of if you fill your financial bathtub with assets that pay you, then like Ben Franklin, you can bless causes that you care about beyond your years. Your pennies can live into perpetuity because you don't just have paper assets you have to sell to deplete to live. You have assets that have distributions coming back in, more tax breaks, leaving more of your capital to keep earning, reinvested earnings. So you have an ever filling tub. Here's just a quick picture of these two great looking guys here. One of them's named Cory Whitesell, and one of them's Dave Snider. And what I'm going to do at this point is stop the chair and let us speak to you for a minute And one of the questions that we inevitably get each time is, well, why you guys? Why should we consider listening to you guys or trying to help raise capital for properties you guys do? Well, we have a lot of experience in real estate and a lot of experience in life and a lot of experience dealing with calamity and dealing with the challenges of businesses and in real estate. Cory was a master's in taxation graduate, a master's in taxation defense from Brigham Young, as well as a CPA accounting undergraduate, served as a CPA and a senior tax associate for Deloitte for many years in Costa Mesa, as well as moved to Charlotte, was senior tax manager for Wachovia and then later senior tax manager for Wells Fargo, has a long track record of being a tax advisor, but for the last decade or so, just operates a lot of commercial real estate, office buildings, restaurants, commercial multifamily, a lot of that, as well as raising the four kids. Cory, tell us the types of challenges, bruises, horrible things that can happen that you've navigated and gone through since you've been at it a while. And how do you navigate around these things? And why should we do business with you and listen to you besides the things that I've already shared?
Yeah, thanks, Dave. So first and foremost, Dave, you asked, why us? One reason I would say why us is we start with a conservative approach, and it's part of who I am. It's who I've always been. Maybe it was part of being a CPA, being trained that way to look at numbers, evaluate, do the what if scenarios, try to figure out how something could go wrong, and then plan for it. So that was my professional career. When I left the W-2 world and started acting as an operator, more an owner operator, manager of properties and so forth, it was a new set of problems. I like to say I had a bag of tricks, a bag of experience, good and bad, that I'd learned through working as a CPA and doing things kind of on the side during those years. But since then, since I left the W-2 world, some of the things that I've dealt with is COVID in the restaurant space, and in other spaces as well, where all of the contracts, we had some government contracts and government shut down. What do you do when the government shuts down? And the work that we were doing in some lines of business was gone, just nothing there. There's a few things that come to mind. One, conservative underwriting on the front of getting into any deal always gives you operational flexibility, and that certainly helps. It's not always a cushy bank account, if you will, that can help you get through something. Some of the things that I believe, I did three principles. One would be conservative underwriting to start with. Second would be a decisive decision, multiple decisions, and do them quickly. And third is a really, really good team. So in using conservative principles and in making decisions, right or wrong, but making them and learning quickly and making the next best decision has been a critical component for me to get through literally fires, some floods, strong winds, a hurricane, nearly tornadoes in some of the properties. So those things are super important. I'll talk briefly about team before I kick it back to Dave. Team is so, so very important. Just in the last, let's say, 2 years, my insurance team, those that I'm actually paying, to insure the property. But in more than that, getting third parties to help do the adjusting of the claims, let's say. So there's public adjusters that come in and help us get what we're entitled to that you may not otherwise know unless you're an insider. So that's essentially what a public adjuster does. And that's been really critical for us in the restaurant space. We just had a restaurant burn down a few years ago, and a public adjuster allowed us to navigate that process in a way that we're very successful on the backside of that. We could do it on our own. We did a lot better with a really, really good team. So teamwork is something that Dave and I both feel strongly about. It's one reason I was attracted to him and his style and what he brings to a team and he to me. So both of us understand the value of team. We know that if we want to go quickly, we can go by ourselves. And if we want to go further and higher, we need a great team. And that's what we've built and we continue to build on a go-forward basis. So that's kind of my thoughts on how to navigate some of the challenges that I've had. Another day, I can talk about more specifically about some of those and what they were. But those principles are guiding principles that help, and teamwork is critical.
I couldn't agree more. I will say that whether it's a fortunate or unfortunate thing, unfortunately, I think it's some of both. But unfortunately, I've had way too many conversations the last year and a half since, say, Storm Debbie or Hurricane Helene with adjusters about projects and watching them navigate through that process. It pays to have professionals that know what they're doing to assist you with when it comes to tax revision on property values, but also insurance claims. We wish these things didn't happen, but we know that they do. We both invested long enough to know that fires, floods, and hurricanes and tornadoes and all kinds of other and unanticipated items come up. So you have to underwrite to protect against them. As I say, maintenance always costs more than the seller will let on. And so you just have to factor that in and say, this is our experience with what will happen with regards to maintenance. So therefore, we can only offer you this because of these realities. Generally, a seller will always try to share that no, 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 no. My reality is much more bright and pretty than yours. We don't have bad things happen, but they do. So bad things happen to good people. But we'll cover a little bit more of that towards the end when we get into Q&A. I want to get back into sharing just more of the presentation of what we do and why we do it and where we do it, so that some of you have that as a basis to understand. We have been investing for years so that you can earn more and worry less, and passively and repeatedly. And if you like impact investing, we do a lot of what's called impact investing, and we actually invest alongside of the capital of others. So our capital is in the deals that we sponsor and that we fund. The mission behind the math, notice that 94% of apartment residents out there today are unchurched, representing one of the most accessible mission fields in America. We think we just connect them so that they know more than two phone numbers. Most of them, half of them in B and C apartments do not know two phone numbers of nearby neighbors that could keep their kids overnight if they got whisked away to, say, an emergency room at night because something broke in their body. So we intend to connect them so they know at least seven neighbors. And 35% of today's US population now lives in apartments. And tonight, over 100 million apartment dwellers behind 100 million doors will go to sleep tonight wanting this sense of belonging. Our question is, what if the place they finally found they belonged were the place they actually lived? So we like to do that. And when you do that, it drives down your turnover costs. You have less people leaving once they get to know their neighbors and they like their neighbors or love their neighbors, however you want to say it, or not so alienated from their neighbors. We live in the most technologically connected universe and world ever, but people live just inches and feet away from neighbors they've never met yet. So by having socials and potlucks and dessert socials and resident appreciation events and that sort of thing, building true communities with homework clubs and online and in-person tutoring for children, big brothers, big sister partnerships, supper to dessert clubs, monthly resident appreciation events. By having all of that, you drive down turnover, you drive down the marketing cost to fill empty units. Witten Data, for what it's worth, did a study of 55 communities that invested in resident connection and resident appreciation. And this was from Arizona to Georgia, so all across the United States. They found that the operators that invested in resident connection, as we do, averaged 138,000 to 180,000 in net operating income improvement. If you do the math, that's worth millions without touching rents. So it's powerful. There are many powerful ways to address ways to increase your net operating income. And we know a lot of them we don't have time to talk about today, but we'd love to share that with you later. Where are we buying? High growth markets. Dallas Fort Worth in the northern part of it, where the employers are pouring in like crazy, wherever employers are pouring in. Cory lives right in between Greenville, Spartanburg, and Columbia and has properties and projects in both those as well as Columbia and other areas. And so we shop in the markets near us. North and South Carolina, employer rich, where people are moving in every day and employers are moving in every year. Tennessee East, that is a lot of it is Knoxville, Tennessee. And then, of course, Dallas Fort Worth, just those growth markets. That's where we specialize. And we're also looking, and we'll tell brokers, we're looking for pricing dips with growth upside because we know bad things can happen. We will do the value add renovations. We will correct operational inefficiencies, including connecting the neighbors so that they know each other. And we only pursue assets where mispricing is caused by capital structure. We don't buy on hope, as people who are now selling at a loss do. We are buying what they did. We are stewards, and we were taught young to serve as unto God, not merely unto men, to lead, and that everything was a talent to be multiplied. So that includes our bodies, our families, our marriages, all of those things. Impact investing is important to us, as we've mentioned, connecting neighbors, driving up the net operating income, but also you enrich the lives of these people. If you've got a third of our neighbors in our country living in these units, they're raising kids there. The average first time home buyer today is age 40. When I bought my first property at age 24, the average first time home buyer was 28. It has climbed to over 40 today. So many people are raising families in these communities. And why is disciplined capital positioning now and not waiting? Well, because we're going after these assets that we can buy at pennies on the dollar. And therefore, if you structure it correctly and utilize the 100% bonus depreciation, many investors see that they receive 35 to 80% back in the way of tax loss, K1 tax losses to offset other income. So you get a huge tax efficiency on the way in, as well as the compounding effect of using exchanges. And so one of my friends that's a surgeon has cut his surgery practice from the Mayo Clinic back to 1 day a week, and he's seen his net income grow. That's his curve chart down below. It's not mine, it's his. I can tell you that you can see strong returns. But here's something that a friend up in New York, Long Island area asked me. He said, Dave, I'm a 72-year-old retired small business owner. If I put 100,000 in this, what can we hope to get? And so I went to the senior partner who was also a master's in finance from Rutgers and had managed 100 CPAs in New York City for 2 decades. And he put this together, showing that, well, if you put 100,000 into it, you're going to average a little over 19% average annual return, but we're going to pay you out about 6% of that, a little under and then a little over that during the hold. So if you add that together, you're really looking at somewhere between 14 and 15% plus the 6% to get you to that number. So you get good cash flow and it's private equity growing. And so you're participating on the equity side. This is what disciplined execution looks like in practice. If you have any questions at all about this, we're happy to have a conversation with you. No pressure, no pitch, and just explain every number on there. For time's sake, we're just giving you a glimpse this juncture. He also asked, well, then what kind of tax benefits can I get? What kind of tax breaks? And we explained to them you'd have to consult your CPA because everyone's income is different and the tax code rewards different types of incomes differently. He said, well, ask your cost segregation specialist what they predict. He said, well, for an average person, they're going to say you're going to receive somewhere around 34 to 36 cents back in your first year per dollar. So if you put in 100,000, 34,000 to 36,000 is approximately what you get your first year. And over the 5 year hold, approximately 50,000, anywhere from 48,000 to 50,000. There are some who receive better than that, but this would be the average. Your results are driven by structure, not market tailwinds, and by laws that were enacted in 2025, which gives you the ability to depreciate the property dramatically quicker than what used to be. So because of that, we are trying to buy all that we can. We showed this gentleman that his 100,000 at 19.1% annual rate of return or average would end up giving him about 195,000 back in 5 years. We hoped to beat that and do better, but that's roughly doubling. And the capital efficiency is, if you want to trade that into another one, you can. With 100% bonus depreciation, let's say he only gets $34,000 tax loss back year one and 50,000 tax losses all the years. He'd have approximately net 50,000 into it that turned into something close to 200,000. So tax strategies allow this. And if you're a high earner, don't go through life without a tax strategy to keep more of your capital working. Our vision for the future for you is that you get to participate in the fact that apartments can outperform stocks and bonds, and partners benefit each year. They benefit long term. The capital gains are deferred by exchanges. And this is a great catch up strategy with annual income and midterm growth. Your capital compounds a lot more efficiency with a lot more efficiently. Should say the right words. So in the next 12 to 36 months, we're preparing now. There are unique opportunities that we are looking at. We aim to be prepared. The good news and bad news is we typically only need about 6 to 10 investors per property. So if any of this resonates with you, the next step is a private conversation. Notice that my email address is david@chateaucapital.fund. Cory's is Cory@chateaucapital.fund, and our website is there on the screen. If it resonates with you, book a call and a private conversation, and we'd be happy to answer any questions you might have. We do pre-fund opportunities, and if you're interested in knowing more about opportunities we're looking at, we're happy to share that with you. Again, at Chateau Capital, we invest carefully so that you can earn more, worry less, passively and repeatedly. And this is a QR code and my calendar app, where if you want to book a call with me, you certainly can. Questions and answers inevitably come up. And I want to show you one of the things that we put together, Cory and I, because we've been through so many ups and downs. One of the things is we have a strategy called the steady framework, how durable multifamily wealth is built, stress tested underwriting, thoughtful capitalization, experienced operators and local execution, asset selection, margin of safety, discipline management and data, and yield with integrity. We aim for strong, realistic returns without financial gymnastics. We know that maintenance will cost more. And we also use a chart called the anchor approach, how we protect capital. Assumptions are built for downturns, non-recourse, resilient debt, no variable debt, capital reserves and contingency planning, high quality asset management, operational playbooks for storms, and risk aligned structures. There's other questions that some of you have, and if you have them, we welcome you to contact us and let us know. But just know that right now, everything we're looking at is a distressed asset. We're only buying if we can buy incredible deals. Cory, do you have anything else that you want to add and or close with as we wrap up today?
Nothing in particular other than we love the opportunity to speak with folks and talk more in detail about some of the things that we've been through, uh, specifically some of the hard things, because there's a lot of learning that happens there. And that's personally where I've gained a lot of experience that's helped me more in the future is through some of those hard things that we've experienced.
Well, I would agree with that 100%. I will also tell you that Helen Keller raised $2 million during a period of time when people thought that was impractical, impossible to do. Her fund last year was worth over 41 million for the blind. And so her vision has impacted not just her life, but also the lives of many beyond it. Ben Franklin affected not only the grandchildren that had not been born yet, but many other people by investing in assets that pay you. We would encourage you to look into that. Don't simply rely on a depletion model. As you look at the founding fathers, as we're celebrating our 250th year anniversary coming up soon, understand that many of them were thinking centuries beyond into what we would have today. And we're blessed. Our tax code actually rewards people that buy assets that pay you. And so your pennies can live into perpetuity. We would encourage you to look more into it. We thank you for tuning in today. We're going to close for now, but feel free to text, call, email us, and we'll look forward to catching up with you again soon. Cory and the rest of you, thanks for tuning in. Hope you all have a fantastic week. See you soon. Bye bye.